please welcome the moderator of the meeting.
Okay, so we're going to get officially started and welcome everyone joining us online to the International Finance Forum's Roundtable on Global Financial Stability, Challenges and Implications. I'm Michael Wang from China Global Television Network, and I have the very distinct pleasure to moderate this roundtable. So in terms of this very big topic, I think everyone attending this session is quite familiar with the overall macro backdrop that the global economy faces today. As we all know, we currently live in this world of pretty high inflation in many parts of the world, but relatively low inflation here in China. So high inflation around the world, slowing growth with rising risks of recession. We have tighter financial conditions as well. Of course, continued challenges from the pandemic, the ongoing conflict that we see in Ukraine, energy disruptions, and overall elevated geopolitical tensions around the world. So I think suffice to say, all of these coming together all at once is a pretty highly complex confluence of risks for international community to grapple with right now. And our main topic of discussion revolves around financial stability. My perception is since the end of last year, the beginning of this year until now, we've sort of gone from worries and concerns about inflation to concerns about slower growth. And now, perhaps with this volatile mix of risks and uncertainties, should we be increasingly concerned about global financial stability as well? I mean, inflation, of course, still a major concern, but global financial stability, could we be more concerned about that right now, given where we are? And when I think about the macro backdrop, it's kind of striking to me because it feels like we went through this decade plus of low interest rates, highly accommodative policies, relatively lower overall volatility, and it seems like there's been quite a rapid reversal into the environment that we are experiencing right now in terms of higher interest rates, more restrictive policies, and higher relative volatility as well. So this decade plus of the low for long environment that we experienced, I feel definitely led to a buildup of vulnerabilities that we see in the global financial system because obviously the cost of capital was rather cheap. And as we transition into this potentially higher for longer environment, I mean, who knows, maybe inflation will be tamed within the next year, the next 1 or 2 years. As we transition into this higher for longer environment, potentially in a rather sudden fashion, I'm wondering, could significant global financial stability risks once again appear to add fuel to the fire of our current economic environment? Or perhaps is the global financial system better prepared today to deal with some of the adverse shocks that potentially may appear compared to, say, 2008 to 2012 during the depths of the global financial crisis and then subsequently the European sovereign debt crisis as well? All right, so that's sort of the lay of the land. If I'm missing anything, hopefully our panelists can add on to that as well. So let's try and get some perspectives on just how concerned we should be about global financial stability with our panelists. And let me briefly introduce them. So we have joining us from Milan in Italy is Mr. Domenico Siniscalco. Welcome. Mr. Siniscalco is a vice president at the IFF. He is also the vice chairman of Morgan Stanley International, as well as Italy's former economy and finance minister. Joining us from morning, Domenico. What time is it right now in Milan? What's the time difference?
9:36.
9:36.
A.M.
A.M. Good morning to you in Milan. Professor Zhou Han-min. Professor Zhou, where are you joining us from? Are you in Shanghai?
From Shanghai.
Okay. Professor Zhou specializes in international economic law and is also a vice president at the IFF. He also serves as a standing committee member of the CPPCC, if I'm not mistaken. That would be China's top political advisory body. Joining us from Hong Kong, we have Henny Sender. Henny is a former managing director at BlackRock, and prior to that, Henny, you were an award-winning journalist. So
most of my career.
For most of your career. So welcome, Henny. Joining us from London is Dr. Chang Sung Young. Dr. Chang is chairman Welcome, Dr. Chang. He is the chairman at South Korean asset management giant Midas Asset. Dr. Chang is also a distinguished research professor at George Washington University and specializes in financial engineering. And joining us from Beijing, that's where I am as well, is Mr. Frank Zhang Xiaoling. Frank is the CEO of Huaan Funds, and prior to that, Mr. Zhang was a deputy director general at China's banking regulator, as well as an economist at the Federal Reserve, and he headed up risk modeling for credit trading at Morgan Stanley. So Frank, welcome to you as well.
Thank you. How are you?
Great. Okay, so let's get the conversation started, everyone. And if I could ask everyone to respond in terms of how they view the current state of global financial stability as it stands right now, given this very volatile mix of risks and uncertainties. Where do we stand compared to, say, previous volatile periods, maybe say compared to March of 2020 during the global financial crisis and whatnot? So Domenico, how about I start with you to sort of give us the lay of the land, your perspectives, and I want to ask all of our panelists the same question first. Domenico.
Thank you very much, Michael. I believe that, well, let me jump to the conclusion. I believe the markets are much stronger, banks are much stronger, etc. But we are not in a cycle. I believe the cycle of zero inflation, zero rates, etc., came to an end for the basic reason that the balance sheets of the central bank are enormous, and inflation is becoming the new risk. So we are entering a phase where the money is scarce again, and I believe that will change. That said, inflation in the US is probably very different from inflation here in Europe, that in Asia, of course, where it's much lower. This explains the difference, different policies. But I believe we entered a new phase rather than a cycle.
Got it. Henny, what about you?
So, the last time we had the global financial crisis, it was all about overdeveloped financial systems. I believe this time financial stability will stem from geopolitical tensions and growing protectionism in the world today. And I started, I wanted to make my first points about monetary policy and fiscal policy in the US. And I contend that a lot of monetary policies and fiscal policies in the US are ultimately protectionist and predatory. And, the Fed talks about how we need to raise interest rates. And when the Fed raises interest rates, the whole world feels the consequences because of wage inflation in the US. But the primary problem is immigration. If you cut immigration by half, if you stop the most talented people in the whole world from coming to the US, you will have price and wages going up at the high end. And if you stop all the Mexicans who want to pick the fruits and the avocados and the almonds in California, you will have wage price inflation at the low end. So the world is going to increasingly suffer because the US policies are designed to put America first. And then in the next round, I will talk about some of the fiscal policies, especially when it comes to things like ESG.
Okay, great. Thanks for that, Henny. Interesting. So geopolitics, perhaps, and protectionism as potential drivers of financial instability going forward. Let's see, Professor Zhou, how about we come to you in terms of your perspectives on where we stand in the current global financial stability landscape?
Actually, whatever you have raised, stated, your worries, your concerns, and your doubts, actually are realities of the world today.
Mm.
How to stabilize it? I will say the China practice, as well as China's endeavor in that perspectives are quite important. Because from the year 2013 to the year 2021, in total 9 years, the overall contribution of China for the growth of the world economics amounted to 38.6%, meaning 20% more than that of the United States, plus another 6 countries in total we call G7. The overall G7 contribution to the economic growth in that period was less than 26%. So I just try to say the economic situation nowadays will make the newly emerged economies, especially those low-income countries, much more difficult to deal with their daily needs and wants. We can see 3 phenomena very actually are the realities, as I said. The first one is the local currencies depreciation in many countries. Very big amount or percentage. The second is the outflow of capitals, especially that of hard capital, meaning the currencies could be very well used everywhere, anywhere in the world. And the third is the very hard inflation. That is why the policy today in China is just try to hit on any possibilities of the coming up of inflation from January to September. In 9 months, the average increasement of inflation in China was 2%. Why that could be the case? I think 2 elements are very much important. One is thanks to the harvest in the sector of agriculture, especially how to stabilize the prices of the selling of pig or meats. And the second is the stabilization for the prices of those energy supplies, including oil, natural gas, the coal, as well as we call new and green types of resources. I will go back to that part later on in the second round of discussion. Thank you.
Okay. Great points, Professor Zhou. So China indeed sort of, I guess you can call it an outlier in the high inflation environment that we are in right now. This is the world's 2nd largest economy. And like Professor Zhou said, China able to maintain food and energy price stability as well. Professor Zhou, if I may have a little follow-up question in terms of how you think China was able to maintain supply chain stability as well, sort of during the depths of the pandemic, if you could share with our audience abroad and here in China.
China is the largest country with the possibility of the growth of consumption. But the consumption rate this year is not that ideal at all. In the previous 9 months, starting from January to September, the increasing rate was 0.7%. That is why the overall GDP increasement was just 3%. By the comparison with this time of last year, that was 8.1%. How to keep up with the supply chain is a very big issue. We have 2 ways to do it. The first one is we just try to have all those economic driving forces to play well, even though the difficulties and obstacles and problems are so immense. I refer to the Yangtze Delta area, the Pearl Harbor, the Pearl Delta area, and also part of area in the north part of China. Especially the Yangtze Delta area played well to keep up with the chain uncut. I would just take international trade as an example. In the previous 9 months, the increasement of exportation in China was over 22%. How to keep up with that? Even though Shanghai was locked down for 3 months. However, for the previous 9 months, Shanghai is still #1 in the world for the container shipment, meaning this is kind of extraordinary effort from the part of the sector here, the trading sector here in China, even though the trade sector contributes less than 4% of the overall supporting force for the economic growth in China. Still, this is very much important for the labor market, as well as for the related sectors to grow up. So to keep it, firstly, to do yourself, especially very better or very good or well performance in those areas I mentioned. And second, just try to keep the door open to have more international trade as much as possible. I give you one example is the development with ASEAN countries, another 14 countries of RCEP, RCEP. The growth of trade between China and another 14 countries of RCEP actually still leads the way of Chinese international trade. That's a very big amount, almost 36% of the overall trade China nowadays is doing with those countries in RCEP. So my answer to your question is, we have 2 balls rolling. One is internal and the other is external, to keep both balls rolling. Thank you.
Okay. All right. Great. Thanks for that, Professor Zhou. Frank, if I could come to you, and if you could give us your opening remarks in terms of how you see global financial stability. And if I may add, because Professor Zhou spoke about the inflation environment here in China, and once China reopens, is that going to add sort of a material amount of reflationary momentum to the global economy, you think? Frank?
Yeah, thank you, Michael. On the financial stability condition, I think in short, this time around, I think the global financial stability is pretty sound, except for some pockets. The reason is because in 2008, the traditional financial system is too leveraged, and the shadow banking system has defect in the liquidity scheme. And this time around, I think the financial system, especially the banking system, is pretty in good shape, and the capital adequacy is high, especially in the US, in China, and in Japan. I think the European banking system is a little bit weaker, but overall, it's pretty sound. And also the shadow banking system, after this 2008, it has quite a lot of changes in the shadow banking system. So it also did not cause a big problem this time. But there is some problem with the crypto financial system. It's also because of liquidity crunch. Because the Fed increased interest rate continuously and in a rapid pace. So there is some liquidity crunch in the crypto asset space. So that's why you have runs on exchange. And you have problems with some asset managers invested in the crypto, especially if they are leveraged. So that's a big major problem in the crypto system. And so other than that, I think the financial system is pretty sound. However, I also see some weak point. One is the emerging market countries, which depends too much on the energy import, and also some countries with affected with the pandemic very seriously. And secondly, as I mentioned, is the crypto system because of the liquidity problem. And third, I think there's some disruption in the supply chain, global supply chain, because of the realignment of the supply chain and the de-globalization forces. So I think this disruption can play a role in the future to keep the inflation high. And going back to China, I think China is at a turning point in terms of macro economic issues, because there are two major forces and affecting Chinese economy at this moment. One is a policy on the COVID control. And the second is all the economic monetary policies to support the economy, such as on the property market and also on the monetary economy. And so to look at these two policies, and first, let's look at the COVID control policy. After 3 years of strict zero COVID, I think, and China at this moment looks like it's prepared to take the next step for reopening. And in the next quarter and 2 quarters, I think how this reopening is going to play out will affect the inflation in China and the macro picture in China a lot. And but looking at the experience of other East Asia countries such as Japan and South Korea, I think the reopening will initially has a negative impact on the economy, and after 1 or 2 quarters, it will recover very rapidly. So I think the inflation, I don't think it will cause a lot of inflation problems in the first quarter and the first half, but in the second half, you may see some pickup in inflation, but I don't see the major problem in inflation because look at the other East Asian countries, the inflation is not a major problem at all. So we will see pickup, but not a major problem. That's my point.
Okay.
Yeah.
Frank, if I may ask about crypto and EM a little bit more, does crypto or emerging market economies, do they have the potential to become systemic risks that can spill over into the wider global financial system? Are you seeing any emerging market economies in particular or segments within EMs that could have systemic risks onto the wider global financial system?
Actually, I don't see major threat to the global economy and from the EM market yet. And
Okay.
because all the major EM countries like China and India and Brazil and the big EM countries, I think they are doing fine, and I don't see major financial problems from these countries. And some smaller countries, yes, and but they don't pose a major problem to the global financial stability. On crypto, I think I don't see major problem yet at this moment as well, because they are not very intertwined with the traditional banking system yet. If we allow them to be very intertwined with the traditional financial system, we may see a major problem to the financial stability in the future.
Okay, got it. All right, thanks for that, Frank. Dr. Chang, thank you so much for your patience. If I could get your opening remarks, and you wanted to bring a more micro perspective to this as well, in terms of how companies, how firms are dealing with the complex environment that we're going through right now, through this tightening cycle that we are currently undergoing.
Okay. Actually, my concern about finance stability come from private sector. Private sector now already have difficulty in accessing to credit market, capital market, and venture capital. So actually, it's already serious, especially emerging market. So now, if the company with a low credit rating almost blocked to having new funding, okay, or new financing. So my concern is now the liquidity is drying up for private company with less credibility rating, and even government sovereign wealth debt, especially over emerging countries, having difficult to refinance in international market. And now, because of a strength now of US dollar, even they have difficulty in servicing dollar-denominated loan. So now company is trying to, also their access to capital market is now very limited. And so IPO, many IPO of companies are now being canceled or postponed. So total now liquidity in the global finance system for private sector is becoming reduced and causing some financial strain for private sector for their operation. And this affects the whole spectrum of business activities now around the world. So that was my opening remark, and I will elaborate more.
Okay.
This question.
Okay, thanks for that, Dr. Chang. Domenico, do you agree with, are you seeing that, what Dr. Chang is describing, that you're seeing perhaps it is a little bit more difficult to get financing now for corporates? What's the situation like over in Europe? Because that would definitely have financial stability concerns with regards to the current loan portfolio on the balance sheets of financial institutions. Domenico, you might have to unmute yourself first.
Yeah, can you hear me now?
Yeah.
Perfect. The problem is that markets for many months have been closed in Europe because of rates. Now they start working a bit better. I'm not talking Europe only, I'm also talking the US. I believe this is a necessary transitory phenomenon on that. That said, rates will not go back to zero.
Yeah.
And particularly the QE will not intervene in the market they used to. Quite on the contrary, we are talking about QT, quantitative tightening at the moment.
Yeah.
That said, it's more the market opening and closing rather than interest rates that are concerning here. Let me close by saying that a major negative factor for stability, let me be paradoxical, but it's also the ECB policy, because here we keep on raising rates to lesser extent than the US, but we are raising. And it's not the right prognosis because we are talking about a supply side inflation. Rates can help on the expectation side, but if you talk to the sources of inflation, you can bring interest rates up to it doesn't matter how high, but that will not lower the price of gas or the price of energy or the supply chains.
Yeah. Domenico, you wanted to talk about the differences perhaps in the inflationary environment between the United States and the Euro area. So if you could expand on that a little bit more in terms of what these two areas are facing in particular.
Absolutely. Simplifying a bit, the US inflation is a demand side phenomenon. Is injected by ultra expansionary fiscal packages and still zero interest rate at the time. So that overheated the economy. It was superimposed to the supply side phenomena that Haley was describing. So bottom line, it's appropriate somehow for that economy to increase interest rates. In Europe, we didn't overheat the economy at all, but rather it was the effect of war, inflation, energy prices, and supply side repatriation. So again, it's not all black and white, but it's mostly a supply side phenomenon that doesn't lend itself very much to interest rates prices as it happens. So that is the main difference. Of course, we rose less than the US. We are coming to the peak of inflation also because we will become to a ceasefire in the war sooner or later, but still it was too broad brush as a policy.
Mm. So Domenico, how confident are you? I'm going to ask Kenny a similar question in a second, but how confident are you that the ECB can indeed navigate the euro area economy into perhaps a softer landing? I mean, it is difficult with the EU overall facing much higher energy prices, and that is perhaps a problem the United States is not dealing with. Well, I mean, on a relative basis, but what do you think? How confident are you that the ECB can really sort of navigate this into a softer landing? Which is difficult because there's only so much monetary policy can do on that front.
Yeah, the most difficult factor, the source of difficulty is the fact that Europe is not a homogeneous area. So there are countries which navigate pretty well, decently, the energy crisis, France with the nuclear, Germany with the storage, etc. Other countries which are more exposed and also more exposed to interest rate raises. So it's not a unique area. It's not an homogeneous area.
Mm.
As many people said, it's not an optimal currency area too, but that would be too long to discuss. So bottom line, I'm confident, but not very confident.
Got it. And you would echo, Domenico, you would echo Frank's point that the banks in Europe, in terms of liquidity and capital buffers, are decent this time around, right? So Frank was saying maybe not as good as, say, the United States and not as well capitalized maybe as, say, here in China, but compared to, say, 2008 to 2012, European banks are relatively better capitalized and more liquid.
Absolutely.
Okay. All right.
Absolutely. And let me add that companies in the real economy restructure themselves pretty briefly, introducing new technology, etc. So the whole system, not only banks, is stronger.
Okay. Henny, I want to come back to you, and same question in terms of how confident are you that the Fed can navigate this high inflationary environment into a softer landing, thereby decrease the risks for financial instability? I was taking a look at a survey of recession risks for the US economy for next year, and it seems like where we stand at the medium level is a 65% chance of recession in the US next year, but potentially a mild one. But recession risks range anywhere from 0 to 100%, depending on which financial institution you look at. But how optimistic are you that Mr. Powell can really help the US economy navigate into a softer landing?
Now, the question is, how pessimistic am I, not how optimistic.
How pessimistic? Okay, I think you have an answer right there.
Pessimistic. So, Frank was talking before about crypto.
Yeah.
Crypto, to me, and the valuations of crypto before the tightening was a symptom of an asset price bubble. And the Fed always talks about the real economy and inflation in the real economy. They never talk about asset price bubble, financial asset prices. There was a huge bubble in the States. The most obvious symptom of that was crypto. And crypto became ever more correlated with technology and NASDAQ. So what you are seeing is a correction in the most inflated financial asset prices. But you also see it where asset prices meet the real economy, and that's housing. And you raise mortgage rates 400 basis points, you will see housing, which is so important to the real economy, as well as asset prices, correct. So I think the chances of a recession are very high in the US. And I think, we're all concerned about the banks, but actually, and I totally agree with Domenico's points that the banks are in relatively good shape, but the banks actually don't matter as much today as they used to matter. And you need to look at private credit as well, which is much harder to figure out, but where you see really predatory lending rates. You need to look at asset management flows. So, if you look at if you take a longer term perspective, what you will see is that countries will become uninvestable because they will become unlivable because of global warming, as one example. So I think we shouldn't overly focus on the banks and congratulate ourselves because the banks are better capitalized today. So just to summarily, I do put the risk of recession quite high in the US. And I think you will see, major corrections in a lot of asset prices.
Mm. And Frank, you think asset valuations right now pretty stretched? Because if we have a devaluation, that could lead to financial instability risks as well. And would love to get your perspective in terms of whether or not you think, has the Fed perhaps over tightened as the most important central bank in the world? I mean, the Fed was talking about last year, inflation was transitory, but this time around, might the Fed have over tightened? Because we do have this lag, right, between monetary policy and when that policy actually hits the real economy in full force.
Yeah, I think the Fed, okay, Chairman Powell has made a very important speech 2 days ago. And I read the speech very carefully. And I think I can understand their path to the monetary policy is pretty clear. And for the Fed right now, the inflation is still far too high. That's their assessment. And the core component of the inflation, one is goods, which is falling. The price is falling. One is housing, and expected to fall. And one is labor component. And the labor component is much more difficult to predict and more uncertain. But the Fed believe that after this very aggressive hiking campaign this year, and it's time for them to moderate. So I think based on a lot of information we have gathered so far, especially the labor market, you see a lot of the big technology companies, they start to lay off. And I think this is going to affect the labor market a lot. Because the most important component for the inflation is the labor market. And so, of course, there is still some disruption on the structural issues on the labor market, but the overall demand and the contraction on the labor next year will put a major pressure on the inflation to go downward. So I think the Fed is going to be successful in eventually controlling inflation. That's my view. And because they learned a lesson in the 1970s, and they have been very aggressive this year. But whether they go too far, too fast, I'm not sure, because right now the inflation is their most important enemy. And the Fed chairman made it clear that they would like to suffer some kind of a sub-trend slow growth in order to bring the inflation down. And also Chairman Powell has made it clear that the problem in the past has been exited too early in hiking. And he does not want to repeat the same mistake in the 70s. So I think I still have confidence in the Fed to bring down the inflation, but I think it's very likely that we are going to see a recession next year. And I would guess it's more than 50% chance we're having a recession next year. And that's my
what about the magnitude of that US recession, Frank?
I think the recession will be shallow. Yeah, I have been reading a lot of research recently, and because the US economy so far is, especially consumption, is still resilient, and also I think the earnings so far, we are going to see the earnings in the next quarter, but I think the earnings so far is also relatively resilient. So my guess is that the recession will be shallow in the US.
Okay. And you essentially then think inflation has peaked then, I guess, in the United States.
Yeah, most likely, yes. Yes.
Okay, sounds good. And let me see if we have Dr. Chang and Henny back because
I'm back.
okay.
I'm here. I'm back. I'm back.
Okay.
Yeah.
Okay, I can see all of you now. Fantastic. Dr. Chang, if you want to respond to any of the remarks our panelists made so far, and then expand on what you were talking about earlier in terms of how corporates, perhaps how companies can better adjust to this high inflation environment where funding can be a little bit more costly in terms of financing, and the cost of capital overall is rather becoming more expensive.
Yeah, and actually now, especially the high-tech companies,
Yeah.
startups and the high-tech companies, actually they are responding by lowering their valuation. For example, last year, one unicorn companies, they raised the capital, the valuation of close to 1.5 billion. It's real case. And recently, they raised the fund at the valuation of only 200 million. So now they lower the expectation and they lower the valuation to accept the new money because now securing cash is the best. So they are all going out, venture capitalists, and they try to get the money, fresh money. And as you see, now even the superpower Wall Street, super powerhouse Wall Street, the Blackstone, even they cannot accommodate all withdrawal requests of their fund. So they limit withdrawals because their investors are also now getting out of to secure cash. So, this kind of, there is some, big difference between public side and the private sectors regarding the availability of new money. So you can see, if I add one thing about whether Fed can control inflation or not, I'm not sure. Because if we look back, it was November 30 of last year. The chairman of Fed admit, now, the inflation is serious. Before, how they claim, it's a transitory, right? Transitory, inflation transitory, you don't have to worry about. But last year, November 30, first time they officially admit there is inflation rate. Already, but that time, year to date, inflation rate was over 6.8%. But their target rate is 2%, right? But already, but they didn't accept or admit you have to deal with the inflation. And finally, they admit and they start. Okay, that's my point.
So speaking of inflation targeting, Domenico, do you think we need to rethink inflation targeting overall, and especially perhaps inflation targets at 2%? Because it seems like that era of low for long and really cheap money, that really sort of built up vulnerabilities in the financial system that can lead to debt really piling up. So should we rethink inflation targeting as part of the monetary policy framework?
I believe yes.
You believe, yeah, okay.
Because the 2% was too low and was too rigid. During my days in government, the ECB never hit the 2%. It was higher or lower. But apart from that, even around the 2% as a region is too low. I just consider the fact that during Dijsselbloem, the head of Eurogroup in Europe, they were talking about lowering this target. Now we're talking about raising this target. Probably is yet another reason to a bit more vague, also on the grounds of credibility.
Yeah, for sure. Domenico, I also want to get your take on disorderly tightening of financial conditions, is what the IMF recently said in its latest global financial stability report. they draw attention to that. They want to prevent that. So being in government before, what do you think policymakers can do to sort of help economies really prevent this sort of disorderly tightening of financial conditions? I mean, I feel financial conditions since, I guess, the start of November we've seen, or actually late November, financial conditions have eased somewhat. But let's say compared to obviously the decade plus of low rates, it's tightened quite a bit. So how do policymakers better ensure we don't have a disorderly tightening of financial conditions?
Well, the obvious response would be a closer coordination between central banks, maybe by the IMF or through the IMF, or in Europe through the BIS, the Bank of International Settlements. But apart from that, I believe that the main risk is pro-cyclical QT, a pro-cyclical tightening when the moment would require the other thing. So a lack of coordination between real economy and monetary economy cycle is also a risk. By now, I would be very happy if the central banks could coordinate.
And you're sensing that there's not enough coordination between the world's major central banks. So we're talking about the ECB, Fed, maybe PBOC, BOJ, just not enough coordination on those fronts.
Well, if there is a risk of disorderly QT, and if people talk about that, of course, there is not enough coordination. That said, even a coordinated, stronger QT would not be a great idea.
Okay, got it. Henny, I want to come back to you because you wanted to talk about fiscal policy as well in terms of how that might potentially have an impact on financial stability in general. If you could expand on that point.
Well, what I wanted to talk about is when I see fiscal policy in the States, it is increasingly protectionist and predatory, and it gives companies in the States much less incentive to innovate. So if you look at the weirdly named Inflation Reduction Act, it's all about saying if you want to sell in the United States, you better be in the United States. And that means the quality of growth is going to suffer in the States. There will be less productivity. But, you know, Dr. Chang and I were talking before this panel about Hyundai, and Hyundai is so important to the Korean economy. Yet the United States is saying after a certain short period of time, if Hyundai wants to sell its EVs in the States, it better make them in the States. And if you're the Korean government, what do you do about that? And, you know, it's funny because the lessons of World War I and World War II are very interesting. So Japan felt justified in attacking Pearl Harbor because the US had an oil embargo on, and oil is lifeblood to an economy. So you see these kinds of tensions in the world today. And at the same time, there was a wonderful book written about the central banks between the two world wars, written by an IMF person, and it was called Lords of Finance. And they start out with an anecdote, and Lloyd's of London, the insurance brokers, are going to the British government in 1912, 2 years before Britain and Germany were locked in war, and says to the British government, if the Royal Navy sinks the German Navy and the German merchant marines, they will sink Lloyd's of London because we've insured them. So you had this degree of at least, you know, regional, if not global cooperation. And no one thought that there could be a war because it was so much not in the interests. But then you had one of the cruelest wars ever. So, you know, these are my concerns, that predatory policies means the quality of growth suffers, there's less productivity, and there's more tensions in the world today, you know. So these are my concerns. And, monetary policies that are raising interest rates in the US have huge spillover effects and challenges for everywhere in the world. And they will lead to capital going more and more to the places that don't necessarily need it the most.
May I add something on that very briefly?
Yeah, go for it.
The disruption of the supply chains with repatriation or at least regionalization of imports is a trend. For the beginning, we all thought it implied lower growth, which was a political choice in a sense, but also it's pushing up inflation because the products manufactured domestically cost more than the products imported from where they are cheaper. So bottom line, it has plenty of issues, plenty of problems, in my opinion.
Okay. You're talking about so-called friend-shoring supply chains, right, Domenico?
Yes.
Okay,
The
regionalization.
globalization of friends.
Globalization of friends, I see. And if that is going to have well, I hope everyone can be friends in our international community, right? That is
me
our
too,
hope.
but there are different friends,
Well, right. Yeah. So if so-called friend shoring does become really entrenched, how high do you think inflation can actually go, Domenico? I mean, give us a range here, ballpark range. It's very difficult, I know, but give us a ballpark range.
Yeah. Great.
Oh, Domenico, can you hear me?
No, the line was bad when you talked.
Oh, okay. I was asking you, so if this so-called friend shoring of supply chains gets really entrenched, and this indeed becomes the trend of the future, how high do you think inflation can actually go? I mean, you talked about we're going to be entering this new era, this new normal era of higher inflation. How high could that possibly be, if you can give us a range?
Well, no idea. I believe the impact on growth will be bigger than the impact of inflation. The price level could increase, but not necessarily the price dynamics. So this, but I'm pro-globalization, to clear my bias.
There we go. Fantastic.
Yeah, Michael, can I make a guess?
Please, Frank, go for it.
I think in the US may go to more than 3%. Somewhere between 3 and 4. Yeah.
So then the Fed will have to change its inflation target. I mean, it's yeah, I guess.
Yeah, because in the last 20 years, why we have very super low inflation? Because first of all, we have two financial crises in the US. One is Nasdaq crash in 2000. One is 2008. So this financial crisis have some kind of a deflationary pressure on the economy.
Yeah.
And then we have globalization. We have cheap labor going into the global econ system, and now both these and now we have another. We have deglobalization. We don't have cheap labor anymore, actually, from China, and then we have some kind of supply chain disruption and reversal, and also we have this COVID pandemic lingering effect on the inflation. So I think in the next 10 years, maybe we are go back to more than 3%.
More than 3%. Okay. Henny, you wanted to comment? Go for it.
I just wanted to add quickly that another source of inflationary pressures is this. Mining companies, commodity companies, oil companies in the West have not been investing. And the energy transition is going to take a lot longer than people thought. And that will be another source of inflation.
I agree.
I see. Professor Zhou, would you like to comment on that? Because you wanted to talk about green finance here in China. So I think this would be a perfect segue into your comments on that.
We are all talking about and focusing on the situations in the United States and in Europe. However, as I said before, the situation in China takes a very major role. If we could go back to the normal economic growth as before, or even lower than that. Still, that is a great power to stabilize the world economic situation, including inflation or supply issues, so on and so forth. Just now, we are talking about the inflation in the States has hit the height already. The answer could be yes. However, if you will try to listen to very seriously the comment by President France on the economic policy, especially that very law we call Inflation Reduction Act is concerned, you will see still, even in the West, the national policies on the stabilization of economics and finance are quite different. But it is a saying in China, we just try to pay attention to one's morals uplift while doing our things. That is why 3 stabilizations are very much important for China, in particular, and to contribute to the stabilization of the world at large. The first one is we just try to stabilize the growth rate. As I said, the previous 3 quarters, the rate was only 3%. It's not very much idea at all for the country like China, it is. And secondly, we try to stabilize the job supply. This is the most important thing in China, to make those youngsters, especially those graduated from high schools and universities, can get decent jobs right after the graduation. The third is just try to stabilize the monetary policy. So far as the monetary policies are concerned, if I believe 2 major elements should be taken into consideration. The first one is we just try to lead the market interest rate to get down, not to get up. And secondly, we just try to make those policies very much sensitive to support the areas like agriculture, the areas of those you see small and even much small enterprises to grow up. And the last but not least is the green economy sector. Just now, Henry said, the sectors, including oil, natural gas, the mine, as well as renewable green resources, the investment is not that much in those countries mentioned by ladies and gentlemen just now. Let me go back to China to talk about the endeavor of China for the green economy, or say clean energy resources. We have the following figures. The first, the loans to those enterprises focusing on the green economy. Now China is the largest in the world. Take last year as an example. The overall figure of last year was 15.9 trillion RMB, with the increasement of 8.25, meaning we tried to make the commitment as real, firstly, by the investment. Among that large figure, 47% went to the infrastructure investment. Another 26 go to the green resource sector, and the last 12% for the helping of those enterprises manufacturing the equipment in clean economy. So first, the green loans, especially to make those as the driving force for the economic growth. And the second, we have issued quite large number of green bonds. In total last year was 440.7 billion US dollars. It's a huge number. Even the first half of this year, the figure is very high, at least. The figure of this year, I mean, the first half of this year was almost 40 billion US dollars. The last but not least is the booming up of the the insurance sector for the green economy, both for the enterprises as well as for the market. So I would say all those efforts are very much important. This is what we call a sound monetary policy should work about. And that is the China practice. I never say the practice in China could be taken as the example of the world. Still, this is a practice here and could be taken at least, not as an example, but as reference to the world. That's my point.
All right, thanks for that.
Michael, may I add a quick point?
Please.
With reference with what Mr. Zhu just said.
Mm.
There are two trends which are very important in Europe. One is the green bonds, sustainability bonds, ESG bonds, the whole class. They are trading more, they are trading better than the normal bonds. So there is an arbitrage. And the second one is the so-called great resignation. Retaining the young talent here is a problem. It's not a matter of money. It's not about raising pay. It's cultural. And it will be an issue to be tackled in the future, no doubt.
Okay. Great resignation in terms of keeping talent in Europe, you're saying, especially young talent.
Yeah, but the youngsters. Yeah.
The youngsters. Okay. And how do you see that really tying into the overall, I guess, financial stability long-term of the region? So perhaps companies not having enough talent to drive growth forward. So quite a long-term effect, perhaps.
Oh, yes. But it's not only European. My son is working with BlackRock in New York, and his trading floor is half empty because people are resigning. They want to do maybe occasional jobs, or but with a higher degree of freedom. Who knows? I mean, the phenomenon needs to be studied yet, but it's clearly evident in the Western world at least.
That's a very interesting perspective. So the evolution of work, I guess the culture of work, I guess for millennials and Gen Z, that is evolving, and that could have long-term growth implications for companies, right? In terms of how do you keep talent?
And the inflation.
And the inflation
because
as well.
If you have a talent and you want to retain it in a firm, you don't have many other instruments that pay him more.
Wage inflation.
Maybe he can go anywhere.
I see. Okay. Interesting perspectives. Frank, would you, or Dr. Chang, you've unmuted yourself. Did you want to comment on that?
Yeah, if I may add, actually, regarding the talent, retaining talent.
Yeah.
Now that's the big issue, especially high inflation rate and the high interest rate. These they significantly reduce real wage, disposable income, and as you know, high quality job market is very tight. They are actually fighting for high quality talent, right? But since high interest rate increase the debt service burden of these employees and motivate them to actually search for a new job, higher paying job. And also because of high inflation rate, the cost of life is living is much higher than before. So actually they make jobs, retaining this talent, very difficult job. Now, many companies are redesigning their compensation system to accommodate this kind of pressure.
Yeah,
Frank, are you seeing a similar? Frank, are you seeing a similar phenomenon here in China in terms of this relationship between trying to attract high-level talent, wages, etc.?
I think in China is to a lesser degree, and but in the U.S., because I have so many friends in the U.S. and also I think the U.S. One of the lasting impact of the pandemic is the work style, is the working hours and the working styles in companies, which I think is very interesting because you see the U.S. Labor participation rate is become lower than pre-pandemic.
Yeah.
And one of the major reasons, of course, is people don't like to do full-time work anymore. Some people, and so I think that's something very important. We're going to see how it's going to, whether it's going to be permanent change, or how it's going to impact how you recruit talent. And yeah, I think it's very important. Yeah, in China, I don't see a similar pattern yet, and because in China we still work hard to try to make money is a top priority for a lot of young people, but maybe in the future, yeah.
Yeah. Well, I mean, with technology evolving, I would probably bet that we're going to see sort of this evolution around work habits definitely persisting for sure. Frank, I want to get your thoughts in terms of the green economy and potentially what China is doing to develop its green economy, because the scale of China's green transition is going to be absolutely massive in terms of this large of a developing economy trying to reach carbon neutrality by the year 2060. And we talk about perhaps our path towards carbon neutrality around the world can be potentially inflationary. But do you see a case where, because of China's scale and the urgency to peak carbon emissions and to reach carbon neutrality, that can lead to green technologies being developed and implemented in scale, and that could help perhaps to alleviate some of the inflationary pressures in our green transition?
Yeah, I think 2 years ago, China has a major drive of the carbon neutrality campaign, and which has huge impact on the so-called new energy like EV, electronic vehicles, and so on. And I think I agree with Hani on her point that the traditional energy company, they don't invest enough in the past many years. So we are underinvested in energy. And I think the economy is not ready for the transition from the traditional energy to clean energy yet. So this actually in the short run has inflationary pressure. It is an inflationary source. I totally agree. And but in the long run, depends on the technology, change on the technology. First of all, we don't have choice, but have to move into green energy in the long run. So, but it will be gradual. And at the same time, I think it depends on the technology innovation. But eventually, and to really solve this problem in the long run, I believe we have to use nuclear technology, some kind of like fusion technology in the future. In the future, so it depends on technology innovation. But in the short run, actually, you are going to see a lot of shortage of energy because we are going electrical. A lot of this, energy consumption, like the traditional vehicles going to clean energy, so-called EV, electronic vehicle, it consumes a lot of electricity. So actually, we are going to see it's more like an electricity revolution, and this in turn demands a lot of energy usage than in the past. So I think electricity shortage in China will last for several years at least. So it will be very common for us to have electricity shortage in the short run, and because of this transition into green energy. But in the long run, I think it will be, and as I mentioned, depends on the technology innovation. Yeah.
Okay. Professor Zhou, if I could get your remarks to what Frank just said. I mean, how confident are you, because of China's urgency and scale of its green transition, how confident are you that China can develop green technologies at scale that can lower perhaps some of the inflationary pressures that we see from the green transition? Professor Zhou, you got to unmute yourself first.
The target set before 2060 of carbon neutrality is very much high, because emission at this moment of China is the highest in the world. So we are going to use the shortest possible period of time to cut off huge amount of emission.
Yeah.
Only depends on three things. One is the high-tech development, the second, common people's will, and the third, international cooperation. The first two things could be very well developed here in China, but the third is not necessarily the case. However, one thing is really very much promising. I just give you one example. Starting from 2018, Shanghai held the national level Import Expo, EXPO, Import Expo. I was there for all 5 expos consecutively, starting from 2018 until recently, last month. What I've got strongly was my personal seeing and believing of the fact that at least 4 things or 4 sectors are doing very well in the clean or say renewable energy resources area. The first one is vehicles. Almost all vehicles demonstrated in the show, in the expo, was all clean. And second is construction materials. It's a very big market in China and as well in the world. The third is those products for daily use and for daily needs. They still just try to take the clean economy as a must. The last but not least is the clean energy resources development itself. So I will say international cooperation is something very much urgently need. Still, those transnational corporations are taking China as a good market to further develop all those. So for me, I will say firstly, the challenge itself is so huge. And secondly, we could have very steady progress in the years ahead. And thirdly, I will say, no matter the United States or Europe and some other countries, including Israel, will try to and will be willing to cooperate each other, because this is not only for a country, but for the whole humankind. This is my response.
All right. Well, I mean, we've been bouncing around between the short term, the medium term, and the long term when it comes to global financial stability. But I want to bring it back to perhaps the short term once more, Professor Zhou, because you wanted to give your thoughts in terms of how this high inflationary environment right now and central bank tightening from advanced economies, how that might potentially spill over a little bit more into emerging market economies. I mean, Frank touched upon this earlier as well, but I want to get your take on this perspective in terms of how big of a risk is this, the environment that we are now, to emerging market economies, because we know this high inflationary environment definitely affects the most vulnerable communities the most.
Yes, I have said from the very beginning that 3 phenomena are very common in those emerging market countries. The first and foremost is very much heavy and high, the appreciation of the local currencies. If that is the case, it could be good for exportation. However, exportation is not that very easy way to push and to promote. And second is the outflow of capitals. Why China could stabilize its economy? One more thing I want to mention is the inflow of foreign capitals, foreign direct investments. Still, I just take, you see, this is the first 3 quarters of this year as an example. The increasement of inflow FDI was over 6.4%. Even Shanghai has been hit by the pandemic issues, worldwide notice about it. Still, the increasing rate is still very high, over 7% in Shanghai. So those foreign investments, why much needed? For 3 reasons. Capital is one thing, high tech is the other, and of course, the managerial skills are another. So all 3 could go into a certain place for a certain area of development is something we take as important. So just now I said, for many emerging economies, only outflow, very little, even none, inflow. And the third, the inflation rate is very high. I fully agree with what Henny just now said. Almost all policies, including those bills in the Congress or even the acts themselves in the United States, are all the time taking America first. It is not too bad to take America first as a kind of guidance for internal policy development or for internal policy orientation. However, just because the US economy amounts to 22.4% of the overall GDP in the world, meaning 1/5 or more than 1/5 in the world. So the influence of the policy is never just closed up in one country area. It's worldwide policy issue. So that is why just now I mentioned we need to listen to what President of France said and what was the words he used. He said the act itself is super aggressive. Here, aggressive is a very mild word from his mouth. However, I will say the implied meaning is very strong. So US need to shift a kind of policy orientation on one country to a kind of collaboration and cooperation with others. This is my comment.
So I think you definitely would agree that geopolitics, in terms of a long-term driver of financial instability, definitely there as well. Domenico, how concerned are you about spillover effects into emerging market economies? Because we do see huge capital outflows as the dollar appreciates by what, double digits compared to, say, last summer. How concerned are you about spillover effects into emerging market economies?
Well, this is a very old story. The effects of the dollar and US monetary policy on EMs and Europe as well, because Europe is stronger, of course, than the normal EMs, but it has been affected by the appreciation of the dollar pretty dramatically. That said, all the bylaws of all the central banks I know focus on the domestic economy. They don't focus on the other economies, and would be pretty complex to ask the Fed, for example, or ECB or whoever, to consider also these effects who are, they're not unintended, but they are not certainly the main object of the policy itself. So yes, I'm concerned, but I don't believe there is much to do.
Okay. I mean, emerging market high yield credit, I mean, it's pretty elevated these days, but you also are in Frank's camp in terms of you don't see any systemic risks in terms of spillover effects impacting EMs that could affect the wider financial system, right? This time around is truly different.
Yeah, and also, I must say, I'm concerned one by one. Even if there is not a systemic risk for the EM, I believe it's very unfortunate.
Yeah. Okay. Frank, what about this recent risk that we've been seeing in terms of open-ended funds, especially open-ended funds that invest in potentially illiquid assets in emerging market economies? I think the IMF definitely drew a lot of attention to this as well. A lot of Wall Street banks also saying this could be a fragile link in terms of financial stability these days. These redemptions from open-ended funds, and we saw sort of a squeeze back in, I think, March of 2020. How big of a risk is that?
I think it's always a risk that if you invest in a liquid asset with the open-ended fund, because you have a mismatch of the liquidity of your asset and your liability. Because your liability is very liquid, but your asset is not liquid. And also it's sometimes difficult to sell, to turn into cash. But I think the worst is over, because this year, 2022, actually when the US is aggressively increasing interest rate, and the dollar appreciates a lot, I think it's very tough for a lot of emerging markets. And you see all the capital outflows from the emerging markets. And however, I think the worst is over. I think when as Chairman Paul has mentioned, we are going to see the moderation of the increase, the pace of the U.S. interest rates in the next meeting. And maybe next year we are going to see even slower pace and even holding of the interest rate for a while. So I think you see the dollar index has actually depreciated actually in the past months. So actually we are bullish on the emerging market. And why? Because first of all, U.S. monetary policy no longer is a big headwind. And second, as I mentioned, the dollar liquidity will be better next year. And also China reopen is another major boost for the emerging market. And lastly, the geopolitical tension has somewhat eased in the last several months. And for example, the U.S. and China president has a very good meeting, and in Bali, and also the Russia-Ukraine situation is also, we may see some end to this conflict next year. So I think the risk on effect will have a very big boost to the emerging market next year.
Okay, got it. So based on everybody's comments, because we're a bit short on time now, based on what everybody has said, it seems like at least in the short term, in terms of a global systemic financial stability crisis, we're not going to be getting one of those, are we? Right? So I think we can all agree, all the panelists agree, global financial stability, we should monitor it. We should monitor the risks, but we're not going to have a full-blown crisis on this front, right? Frank, you were nodding your head. You definitely agree. Domenico, do you agree? No financial stability crisis?
Yes, unless inflation does crazy things.
Unless inflation does, well, okay, well, you got to give a context then for that, right? How do we get to inflation doing crazy things?
No,
So,
I mean, if it skyrockets, then the central banks would overreact.
okay.
Let me say one thing,
Yeah,
though, that if you consider the distributional effects of interest rate raises and QT, etc., and the impact on growth of employment in the economy, this, I believe, requires some debate about the independence of central banks. Because when central banks were doing only interest rates for the inflation, there was plenty of reasons to push for independence. Now that monetary policy for many years influenced the real economy, and it's if there is a trade-off, and in reality there is a trade-off between financial stability and short-run effect on the economy, I believe that some debates, I'm not in favor of dependence of central bank, but I believe it should be addressed.
okay. I mean, we do have to think about, right, the trade-offs between monetary policy in general and financial stability. I mean, should financial stability occupy a higher rung in terms of policymakers' priorities? I mean, it seems like inflation targeting, it should, right? I think it should.
It does already.
It does already in Europe, I think, for sure. In Europe, for sure.
In the US.
Okay. All right. Okay. We have about 4 minutes left in this discussion, and I'm not sure how many people we have in Guangzhou in the audience, and I'm not sure if anybody in the audience has a question for one of our panelists as well. Let me see if I can see them a little bit better. Does anybody from the audience in Guangzhou have a question? Joanna, I can't see who's there. Is anybody raising their hand, or is anybody maybe joining us online have a question also? Guess not. I can't really see the venue site in Guangzhou, but okay.
没有提问，没有
All right, there is no question from the venue.
If that is the case, are there any final remarks or responses that any of our panelists want to respond to another panelist? And if not, then we can wrap up. Anybody want to say any final concluding remarks? Henny, go for it.
I just want to say that I think all of us have been beneficiaries of globalization. And we were perhaps naive in thinking that borders could only go down. But I just wanted to thank the organizers of this incredible event, because they are just not giving up on dialogues, with the whole world. And I just want to thank you all and say it was just a privilege to be part of this. And I wish it wasn't virtual.
Yeah.
So, thank you so much.
Thank you.
I fully agree with Henny.
I echo that as well.
Thank you.
Okay, so we'll leave it there. I think it was a great discussion. We touched upon both the short-term and long-term aspects. I mean, short-term, I think we can all agree, no global financial crisis per se. We'll definitely monitor the risks, but long-term, we are definitely, I guess, entering into this new era of a more inflationary environment and all the attendant risks of financial stability that comes with that as well. So we'll see how corporates companies adjust to this new environment, geopolitics as a long-term driver of inflation, talent as well in terms of wage inflation, green transition also. So love these long-term perspectives that we bring in, because I think there's just so much focus these days on the Fed, on what the ECB is doing, et cetera, in terms of these short-term movements in inflation, tighter financial conditions. But it's great to have that longer-term perspective as well. I just wish it wouldn't be as ominous as what some of you have said. So again, super important to keep the dialogue open. We are on three continents or 2 continents? We've got Europe and Asia. So hopefully we get North America. we're across Eurasia. So hopefully we'll get North America in next time as well. But I think it's far too early for them. So thank you again to all of our panelists, and hopefully our audience also gain some insights from this roundtable as well.
Nice
Great.
meeting you.
Thank you.
Thank you, Michael.
Great. Thank you, everyone. Thank you.
Thank you.
All right.
Bye. Thank you.
Bye-bye.
Bye.
Take care.
Jen.
Bye-bye.
Bye-bye.
Bye.
Bye-bye.
Bye.